Welcome to this explainer. Today, we're decoding the legendary playbook of a guy who literally redefined the absolute limits of financial growth, Sam Zell. Known in the industry as the grave dancer, Zell's story is just an absolute masterclass in aggressive, highly calculated expansion. We're going to trace his unbelievable journey, from managing a single student apartment all the way up to orchestrating multi-billion-dollar corporate takeovers. So, if you've ever wondered exactly how Sam Zell scaled portfolios to astronomical heights, well, you are definitely in the right place.
Here is our roadmap for today. We're going to map this out using an evolutionary ladder. The micro-scale beginnings, leveraging other people's money, profiting from distressed markets, scaling corporate asset turnarounds, taking real estate public, and finally, the risk and reward equation.
All right, let's jump right into step one, the micro-scale beginnings. Long before the billions, his massive scale started with a really simple observation of what the broader market was just getting completely wrong. Pitching to manage a new 15-unit apartment building despite having literally zero experience, Zell grasped what the seasoned pros were missing. See, professional managers were filling student apartments with this stuffy, outdated furniture to try and create a home-like vibe. But Zell, he actually knew his peers. He knew young people wanted a fun, clean, modern, Scandinavian-style environment. So, by remodeling the interiors with sleek designs, he instantly made his units wildly sought after. It just goes to show, a deep understanding of your demographic is your first real multiplier for scale.
But to truly scale his wealth, he couldn't just manage properties, he had to own them. Pulling together his management income, his personal savings, and a few bank loans, he bought his very first 3-unit building for just $19,500. And here's where the magic scaling mechanism kicks in. He applied that exact same modern interior redesign, which let him immediately double the rents. That fresh cash flow, it was instantly routed to fund his next down payment, creating this rapid snowball effect incredibly early on. I mean, by his second year of law school, he already had a massive head start.
Moving up the ladder to part 2, leveraging other people's money.
Okay, so picture this. He takes a meticulous law firm job and then quits after just 4 days. 4 days! He realized he had to break through his personal ceiling if he wanted to get truly wealthy. To push his portfolio to that explosive $1 million mark, he couldn't just rely on his own bank account anymore. So, in 1966, he pooled capital from 20 wealthy investors, including his own dad, to buy a massive 99-unit apartment building in Toledo. He was basically scaling up his ambition by scaling up his capital base. This brilliantly lays out his early formula for how he scaled portfolios. He zeroed in on growing universities in smaller cities and capitalized on a severe undersupply of quality apartments in those exact spots. Because of that hyper-specific focus, he was buying with zero competition. And the result? He delivered a massive 20% return to his investors in a single year. When you have no competition, your margins can be exceptional. And obviously, he used those incredible returns as a giant billboard to grab even bigger investor checks for his next round of deals.
Which brings us to part 3, profiting from distressed markets.
Now here's where it gets really fascinating. By the mid-70s, Zell is sitting on a multi-million-dollar portfolio. But after his brother-in-law got hit with an IRS investigation, Zell made a vow to build an empire so incredibly massive that no one could ever touch him. That takes a whole new level of scale and some serious contrarian guts. While the entire market was still blindly buying in this heavily saturated, overbuilt environment, Zell looked at the raw data and just stepped aside. People called him crazy because occupancies were still over 90%, but he stopped buying cold turkey while the music was still playing, strictly to preserve his capital for what he knew was coming next.
And then, boom, the inevitable real estate crash hits. The market panics, defaults go through the roof. But because Zell had scaled up his cash reserves by sitting patiently on the sidelines, he instantly transformed into a buyer. This right here is exactly how he earned the nickname, the Grave Dancer. He started scooping up distressed properties on the verge of default, sometimes taking over massive, sprawling assets for literally a $1 down payment.
Through this totally genius contrarian strategy, he acquired roughly $4 billion in assets between 1974 and 1977. By just waiting for the market to fracture and having the sheer conviction to act when everyone else was terrified, he made himself an absolute powerhouse in the real estate world.
Let's keep climbing. Part 4, scaling corporate asset turnarounds.
So Zell had this hypothesis.
If I can fix broken real estate, why can't I fix broken companies? He set his sights on this bankrupt leasing company called ITEL. The board totally dismissed him at first. So what does he do? He just executes a hostile takeover by buying up 22% of the company. Once he's sitting in the CEO chair, his playbook is ruthlessly efficient. He cuts the costs, liquidates all the deadweight, and takes that $50 million in freed-up capital and funnels it to corner the railcar market. He saw that massive scrapping of railcars was going to cause a supply shortage, and he was right. Demand stabilized, supply plummeted, prices spiked, and ITEL's revenue absolutely skyrocketed.
But he's never content to just sit on a win, right? Zell proved that real scaling means fueling high-growth engines with your steady cash flows. He took ITEL's ultra-reliable railcar cash and used it to buy a wiring and cable distribution company called Annixter. And man, this was a massive growth play. Annixter exploded into a billion-dollar-a-year unicorn. With Annixter basically printing money, Zell just turns around and sells off the railcars to General Motors for $2.3 billion, freeing up a mountain of capital for even bigger plays. That is how you aggressively scale and recycle your capital across totally different industries.
All right, part 5, taking real estate public.
Fast forward to the 1990s, and Zell reaches the absolute zenith of finance. He saw this massive opportunity to take traditional, highly illiquid real estate and transform it into transparent, publicly traded real estate investment trusts, or REITs. He packaged over 32 million square feet of premium commercial offices into equity office properties. And what made this just irresistible to Wall Street was the raw predictability of it all. He offered a very sweet 5.7% dividend, completely backed by hyper-predictable 7-year corporate leases. He effectively took bricks and mortar and turned them into liquid assets, building the largest real estate portfolio in the world.
But as any master of scale will tell you, you have to know when to exit. By 2006, sensing a massive financial storm brewing from all the wild speculation, Zell looked for the door. When Steve Schwartzman's Blackstone came in and bid $42 a share, Zell didn't just take the money, oh no. He orchestrated a historic bidding war. He dragged Vornado into the mix, forcing Blackstone to keep upping their price until Schwartzman finally capitulated at $52.25 a share. That is a staggering 24% premium over the market price. He netted an absolute fortune right before the global economy collapsed in 2008.
Finally, part 6, the risk and reward equation.
Because to truly grasp how Sam Zell scaled portfolios, we have to look at the outer limits of scale. Because even the biggest titans face colossal failures when macroeconomic conditions violently flip on them. In 2008, Zell executed an $8.3 billion leverage buyout of the Tribune media conglomerate, taking the massive publisher of the Chicago Tribune and LA Times private. The plan was to run his classic battle-tested playbook, cut the redundancies to fund opportunistic growth.
Now, it's important to note, Zell wasn't being reckless here. His underwriting was actually super conservative. The historical revenue decline for the Tribune was hovering around 3% a year, but Zell prepared for a 6% annual drop. But even planning for double the historical loss wasn't enough against an unstoppable force. The 2008 financial crisis just decimated the economy, and struggling businesses immediately slashed their advertising budgets to zero. The newspaper industry fell to its knees, and the Tribune was pushed into bankruptcy by December of that very same year.
But the most crucial takeaway is perfectly captured by Zell's own reflection on the whole ordeal. He said, "I lost $300 million. If it had worked, I would have made $5 billion. I liked that risk-reward ratio. Would I do it again? Yes." And that right there is the essence of it. Scaling at the absolute highest level is ultimately about calculating asymmetrical risk versus reward without a single drop of emotion. A rational bet is a rational bet, even if a black swan event comes along and sinks it.
Seeing Sam Zell's evolution from remodeling a single college apartment to standing at the absolute pinnacle of the financial world proves one undeniable thing. True scale requires relentless contrarianism. It means stepping aside when everyone else is buying, going all in when everyone is panicking, and constantly recycling your cash into bigger, better engines. So having seen this masterclass playbook, the real question is, are you willing to ignore the herd, dance on the edge, and bet on the raw math to build your own empire?